Hey everybody, Mr. Tweet here. In this video, I'm going to be going over the graph of the market for loanable funds. Now, this is really just a unit 2 graph for loans. This is like the market for loans, like there's a market for shoes or skateboards or cars or peanut butter, whatever. There's supply, there's demand. Supply is upward sloping, demand is downward sloping. The only difference here is that our shifters are a little bit specific for this graph. So that's really the big difference here. Our supply curve, these are the people who are willing to supply loans. So that's lenders, or you really should think of it as banks, that banks are the suppliers here. And then our demanders, those are the borrowers of loans. That's going to be consumers and businesses. So they're going to be demanding loans. And we have our equilibrium real interest rate here and our equilibrium quantity. Although the quantity doesn't really usually matter on this graph, it's really the real interest rate we want to know. So when you're dealing with this graph, you're going to have some sort of shifter that's going to cause demand or supply to shift. And then the follow-up question is always going to be like, what's the effect on the real interest rate? So is our real interest rate going to go up or go down? That's what we're really looking at here. Now, as far as shifters go, the demand for loans, you're going to be looking at consumers and businesses. So whatever makes them more interested in wanting to buy stuff or consume, that would increase the demand, or whatever decreases their desires to get a loan would decrease demand. So what you really see is like when business is good, that would increase the demand for loans by businesses. If we're headed towards a recession, that would decrease the demand for loans by businesses. For consumers, you would see things like consumer wealth would maybe increase the demand for loans, so that like as people are feeling wealthier, that might cause them to want to get more loans. But you really wouldn't see that very frequently as a shifter on this graph. The most common shifters that you see are going to be capital flow and government spending. Those are going to be the two biggest shifters. Now let's deal with the government debt or government borrowing. Really, when the government goes deeper into debt, when it wants to borrow money, it issues bonds. And when it issues bonds, what happens is, people who otherwise would put their money into the bank are going to buy those bonds directly. Or the bank, instead of making out loans, the bank might buy those bonds. But in either case, the way that at least that I show this on the graph is that when the government goes deeper into debt, the supply of money available for loans gets lower because people have an alternative, and that is they're going to be buying government bonds instead of putting their money in a savings account, so that they're kind of like, substitutes in a way. So really, I view that as like a substitute on the supply side. So if the government goes deeper into debt, then for me, I decrease the supply. Or if the government was to run a surplus and they were not to be going into debt, then that would increase the supply more. Some teachers have you shift demand for this though. So like for some teachers, they'd be like, oh, the government goes deeper into debt. The government wants to borrow more. That increases the demand for loans. So government goes into debt, you can either increase the demand or you could decrease supply. On either one of those, you're going to see the real interest rate go up. So again, government goes deeper into debt, they do more borrowing, that's competition for loans funds, that causes the real interest rate to go up. You can show it with an increase in demand or a decrease in supply. The other big shifter on this graph is capital flow. You have to remember that when we say the supply of loans, we're really talking about, like I have a saying that I frequently will use with students, savings is the supply of loans. Anything that encourages people to save more means that banks have more money to loan out. Savings is the supply of loans. If anything causes savings to go down, that would decrease our supply of loans. So one of the most common shifters here would be interest rates in other countries. That if other countries have a higher or lower real interest rate, that's going to cause wealthy people to move their money to those countries where they can get the highest return. So if the United States has a lower real interest rate than other countries, what happens is savers are going to take their money and they're going to go play elsewhere. They're going to go get that higher real interest. So if we're trying to compare, for instance, like Mexico and the United States, you maybe even would want to do like two graphs where you'd have like the US loanable funds market, and then next to it, you could also have the Mexico loanable funds market. We've got our supply of loans, our demand for loans, quantity, and our real interest rate. And if the Mexico real interest rate is higher, then that's going to be some wealthy people are going to take their money out of the United States. The supply of loans decreases to the left. And they're going to put that money in Mexican banks where they can get a higher real interest rate. Their supply of loans would increase. And so what you see in the United States, it causes their real interest rate to go up. And in Mexico, it causes their real interest rate to go down. We call this capital flow. Capital outflow is when supply goes down because the interest rates are higher in other countries. Capital inflow is when interest rates go down because the supply is increasing, money coming in from other countries. So capital inflow, capital outflow, and capital flow is just this general thing that happens when we have money that's going from one country to another. So this kind of leads us into our next unit where we're going to talk about trade between countries and currencies and what makes currencies more valuable in one country than another, or how do you exchange currencies from one country to another. That's all going to be in our last unit, Unit 8. This right here kind of leads us towards that. It shows us that, that what happens in one country affected by what happens in another country. And when it comes to the real interest rate, it should mean that almost every kind of major country, that their real rate of interest should be about the same. Because if one country started getting higher real rates of return, then foreigners would flood that market with capital trying to get that higher interest rate, and it would cause the real interest rate to push back down in equilibrium with other countries. So that all countries should roughly have an equilibrium in their real interest rate. All right, and this model demonstrates that. So that's the loanable funds market. Again, the really important shifters here. Government spending is going to be a big shifter. More debt means either more demand or less supply. Either one is fine. You'll get the right answer on the interest rate, what matters. The other thing is capital flow, real interest rates in other countries, and understanding how money flows from one country to the other, and that if it's leaving, supply goes down. If it's coming in, supply increases to the right, and that'll show you what's happening with those real interest rates as well. So, all right, have a good one.